when I went to Wharton, 1963, the first book I remember learning was called Decision Making Under Uncertainty by C. Jackson Grayson, who became, as I recall, America's first energy czar. And I learned a couple of important things from that book. Number one, that you can't tell from an outcome whether a decision was good or bad. It's very important. Most people don't understand this. Totally counterintuitive. But the truth is, in the real world where there's randomness at work, I mean, if you build a bridge and it falls down, then you must assume that the engineer made a mistake, that it was a bad decision to build the bridge that way. But in the real world of where there's randomness, good decisions fail to work all the time. Bad decisions work all the time. The investment business is full of people who are, quote, right for the wrong reason. Made a bad decision, it didn't work out the way they thought, but they got lucky, and they were bailed out by events. So this is very important, and this is the basic theme of Fooled by Randomness, Taleb's first book. Since then, he has written The Black Swan, which became more famous, but I don't think it's as good a book. And he's written a book called Antifragile. That one didn't get famous. But I think that this book is something everybody should read it if you have an interest in numbers, investing, and how the world works. So it's, as I say, the book is all about the role played by luck. And basically, even if you know what's most likely, many other things can happen instead. This is very, very important. We talked earlier at lunch about what's the most important lesson you can draw. Well, of course, I'll never say most important to anything, but one very important lesson for you to learn is that you should not act as if the things that should happen are the things that will happen. Again, in the world of the physical sciences, you can probably bet that that's true. And the electrical engineer knows that if he turns on a light switch over here, the light will go on there every time because it's subject to physics, not in the world of investing. And so for every possible phenomenon, there is a range of things that can happen. There may be one where it's possible to discern which one is the most likely. And if we draw a probability distribution, that may be the highest point on the distribution, the most likely single outcome. But that doesn't mean it's going to happen.